and welcome to Sectors Up Close. I'm Elena Casas. Today we're focusing on UK midcaps and my guest is Dewi John, Refinitiv Lipper, Head of Research for the UK and Ireland. The British economy is forecast to slow to a standstill next year as it suffers more than any other G7 country from the fallout of the invasion of Ukraine. That's according to figures from the Bank of England today, which is now forecasting inflation will peak at 11% in October. It also says GDP will shrink by 0.3% this quarter. Just last month they said growth would be flat, but even that now looks optimistic. The bank this morning raised rates by a quarter of a point and warned the fall in the value of the pound could add to inflation pressure. So what does this mean for British midcaps that rely on the UK consumer? This is the FTSE 250. It's down about 17% year to date, roughly in line with European counterparts. If we break this down by sector then, it's about 22% consumer cyclicals, which have been struggling this year, 18% industrials, which have also seen a crunch, and 15% financials, a bright spot where banks, insurers and money managers are set to benefit from higher interest rates. So what's in store for British midcaps? Let's ask Dewi John, Refinitiv Lipper, Head of Research for the UK and Ireland. Dewi, hi. As I was saying there, we're talking about companies that are very exposed to UK consumer behaviour, and we're increasingly looking at fairly dire growth forecasts from the Bank of England. So just how much of a downturn should investors be pricing in this space?
I think a lot. Again, you've stolen all my best lines because that kind of sums it up. It's not just the G7. If you look at the OECD announcements or predictions, that Britain is predicted to be the lowest performer amongst the G20, with the exception of Russia. And I'm sure we can all appreciate there are issues with Russia. So yeah, it's strapping. Soft landings aren't looking particularly likely at the moment. I think we're in for a rough ride.
So if we break this down by sectors for UK midcaps, where are you expecting this to hurt the most?
Consumer cyclicals, which is the biggest area, and I think has been one of the biggest drags on performance so far, are not looking great because if the clue is in the name. It's a cyclical. We're in a downturn at the moment. That downturn is going to get deeper. These stocks are already suffering, and I think they're going to suffer some more. And the ability to pass on prices is really quite limited for a lot of these companies.
When we talked about this a few months ago, you said that the link between inflation and employment is always stronger in countries that have a more closed economy. How much of the negative side that we're seeing for UK firms is down to Brexit and trade barriers?
Well, that's what the theory says. The UK is suffering more. I don't think Brexit's difficult to unpick from all the other phenomena that are happening at the moment. I think it's not going to help, and certainly there's going to be a knock to business confidence when you're having to factor in the rows around, for instance, the Northern Ireland Protocol at the moment, and that brings in a huge amount of uncertainty into ongoing trade. I mean, businesses have said all the way through, we want Brexit to be sorted out quickly so we can make plans and move on, and it rolls on and on and on, and there is as yet no end in sight. So I think that's just going to be the gift that keeps on giving.
Are there any upsides to the current interest rate rise? Any sectors set to do well here?
Financials could, because if you look at the banks in the FTSE 100, we don't have any banks, particularly large banks. In the 250, what you've got there is insurers, wealth managers, asset managers, and they have the ability to pass on those increases. That increases their margin. So that could be one bright spark in there. Also, there are the bulk of UK dividends, no surprise, about 80 of the 90 billion pounds predicted to be paid this year come from FTSE 100. The dividend on the 250 in aggregate is about 1 percentage point lower. However, there are a number of stocks in there, particularly within the financials, that actually pay quite a healthy dividend, up around the high single digits, and I think it's 1 or 2 low double digits. So dividends in an inflationary environment and a rate rising environment are again important and take on greater weight, which is why we're seeing a turn to value and why we're seeing a turn to income based sectors.
So how should investors be approaching UK midcaps at the moment?
Well, my knee-jerk reaction would be to say don't buy the broad index. However, if you look at funds in this space, Trackers have outperformed actively managed funds year to date, with I think there are 2 exceptions within the index, and that's because I think active managers have been rather taking a misstep on this. Certainly, I don't think you want ongoing exposure to consumer discretionary and the areas that have been beaten up so far, as consumer confidence continues to slide and there's no bounce in sight yet. And as you said, inflation expectations are it's not going to peak until October. I think you want selective exposure. I think financials still look pretty good, but for the index as a whole, if you want broad exposure, move up the cap scale.
Do you think then that UK mid-caps have priced in most of this economic downside, or could there be more to come?
No, I think there's more to come, and the inflation's still feeding through. There's a lot more bad news out there. I think it's strap in and expect a rough ride.
Well, thanks so much for that, Dewi John, Refinitiv Lipper, Head of Research for the UK and Ireland. Well, before I go, here are some of the stories we're following in this space. British online fashion retailers ASOS and BooHoo both cautioned this Thursday they're being hit by rising product returns as users seek to save cash. ASOS said demand for loose leisure clothing has fallen in favour of special occasion dresses, which are far more likely to be sent back. 2 of London's biggest property companies have agreed to merge. Shaftsbury and Capital & Counties will have a combined estate of £5 billion worth of tourist hotspots, including chunks of Covent Garden and Soho. Existing Shaftesbury shareholders will own 53% of the joint business and Capco shareholders the rest. And Britain's inflation woes could become a lot worse, according to the Institute of Grocery Distribution. It says food prices are likely to rise by 15% this summer and remain at high levels into 2023. It says inflation will be most evident in prices for meat, cereals, dairy, fruit and vegetables. And that's your roundup of UK mid-caps. I'm Elena Casas, and this is Reuters.